What's up everyone, my name is Tim Bryant and welcome to our special weekly episode of Thomson Reuters Backstage. It's April 24th, 2020, and we're going to talk about the impact of COVID-19 on tax and accounting. As always, we try to provide you with accurate and timely information as of the time of recording, but please keep in mind that things are changing quickly. Let's get started. We've talked a lot about the tax and legislative implications of COVID-19, and later in the episode, we'll have an update on additional PPP funding and Q1 Form 941 for payroll. But first, we want to take a look at how the crisis is affecting audit professionals. And to do that, we're welcoming Emily Fickus. Emily is Confirmation's Audit Desk Supervisor here at Thomson Reuters and one of our Backstage hosts. What's up, Emily?
Hey, Tim. So obviously the CARES Act has had significant impact on our industry, but outside of immediate relief packages, there are short and long-term implications of COVID-19 for audit professionals too. Social distancing to combat the spread of coronavirus has transformed business, sending millions of employees to work from home and triggering volatility in financial markets. For systematically essential sectors, such as banking and auditing, contingency plans to deal with catastrophes have long been a regulatory obligation. Still, the coronavirus disruption is markedly different from a standard recovery process. Typically, contingency plans involve restoring critical functions following a relatively short interruption, such as a hack, terrorist attack, or natural disaster. The coronavirus pandemic, however, may slow activity for months and completely refigure business relationships. To ensure they can continue serving their clients, financial institutions and audit firms have quickly pivoted to remote working setups with technology that helps employees continue fulfilling vital tasks without losing productivity. This is forcing auditors to rely on new tools and dramatically change things like in-person interviews and inventory counts. Additionally, increased risk of fraud is a considerable concern. According to a recent Q&A published by the AICPA, auditors should be on higher alert for fraud risks given these uncertain times. Traditionally, economic downturns expose fraud. Just look at how the last recession outed Bernie Madoff. If you throw in the relief packages, now is the time where people will be hunting for new ways to take advantage of the system, and auditors need to prepare. Along with trying to gather evidence remotely, another big challenge for auditors related to the pandemic will likely be the evaluation of their clients' management's plans. For many entities, their plans are in a state of flux with the volatility of the current environment in which they operate, and their plans may be changing daily. Similarly, updated cash flow projections to support management's plans may not be available or may be less reliable because of major uncertainties due to the COVID-19 pandemic. However, the evaluation of management's plans will be necessary for determining whether the company's disclosures are adequate and the likelihood of needing to add a going concern emphasis of matter paragraph to the report. And finally, the AICPA's Auditing Standards Board voted on Monday to defer the effective date of certain newly adopted audit standards by 1 year amid the COVID-19 crisis. It's for the standard statements on auditing standards number 134 through 140 and includes expanded auditor reporting to make the auditor's reports more useful to investors. Tim, that's the update I have on how COVID-19 is affecting the audit industry. However, we will continue to monitor things as they change.
Thanks, Emily. Time for a quick update on the Paycheck Protection Program. Last week, we discussed how the program had run out of the original $349 billion in funding. Congress voted to add an additional $310 billion in funding this week, and the President is expected to sign the bill shortly. The legislation also adds more funding to the EIDL program. And in payroll tax news, remember that Form 941 for the first quarter must be filed by April 30th. The CARES Act allows employers to defer certain deposits and payments, but does not extend the filing deadline. The form is currently being revised to accommodate the new employee retention credit, so the credit for Q1 will be reported in the Q2 filing. Employers seeking an advance refund of the Employee Retention Credit or new paid leave credits for Q1 should also file Form 7200 by April 30th. And that's a wrap on this week's update. We'll be back next week. As always, thank you to Melissa Oakes and the Thomson Reuters Checkpoint editorial team. We'd also like to thank Kate Chandler and the great team at Confirmation for their help this week. Make sure you check out the new resource page designed specifically for tax and accounting firms at tax.tr.com/COVID-19. We're also excited to announce Backstage as a new online home. Visit us at tax.tr.com/backstage to view past episodes and see what's coming. Finally, please join us every third Wednesday of the month for our regularly scheduled Backstage episodes. Until next time, remember that we're all in this together, so stay safe and please
wash your hands. Wash your hands.
wash your hands.